Welcome back to the channel, everyone. Today, someone's run the numbers on the divorced puts and married puts and has figured out that there's around 190 million additional shorted shares that are currently being hidden. So stay tuned and let's make some money. But before I dive into the video, I just want to give a massive shout out to all of the apes that have joined the team on the private Discord and are getting urgent updates, news and due diligence about AMC and other stocks and crypto before I even make a video. And they've been entered into a draw on the 28th of August to win $600. So if you want to win $600 on the 28th of August, all you've got to do is join the Patreon, the private Discord, linked in the description below. And now I want to dive straight in with the key information. So, update to my divorced puts due diligence and how it still shows 189.9 million AMC shares are being hidden away from the true short interest data. Good morning, Motos. Continuing on my role of due diligence posting while I have a week off, here is the update to my married puts due diligence, which I did way back just before the large block of deep out the money puts expired worthless back in July the 16th. For reference, this represented 36.5 million shares of AMC. Disclaimer, this isn't any form of advice. It's just what I found from my digging and my current understanding, which is always evolving and adapting as I learn new information. Also, this due diligence will require some basic understanding of the options market and how the mechanics of naked shorting and fail to delivers work. I have due diligence on these as well, but I don't want to feel like a walking ad for myself, so ask in the comments or via direct message if you want these guides. TLDR, which is too long, didn't read. Simply put, by analysing the existing option chain, we can see that there's a minimum of X number of shares of short interest being hidden in AMC. And more importantly, we have another clear piece of evidence that manipulation and fraud of the stock is still occurring. For AMC, the best we got with that was the save vote data, which I've done due diligence on. Spoiler, you can be 95% confident that there is between 2.5 billion to 6.1 billion synthetic shares. I won't share the link to the due diligence, but if you like to ask, I'll give it to you in the comments or via direct message. And even if you use an 80-20 proportion split or a 95-5, or even just completely removing that 95% and solely using that 5%, you've got at least 1.4 billion synthetic shares. This due diligence also shows in detail one of the three main ways short interest can be hidden, to my knowledge. There is likely a lot more ways it can be hidden though. The main purpose is to show that fraud in the stock still exists and continues to this day. It's all well and good saying it's obvious and pointing generally at them, but this is hard facts, evidence, and a data-led approach to conclusively say that beyond a shadow of a doubt, there is fraud and hidden shares. So what is a traditional married put? A married put traditionally is a strategy used where the holder of a long position, someone that either has stock or options, where they want the price of the stock to go up, buys a number of at-the-money put contracts equal to their long position. This way, if the stock goes up more than relative to the premium, then they earn money. Likewise, if the stock goes down below the cost of their premium, then they'll either break even or earn some money depending on the type of long position they hold and how much value of that position is lost. This, in a way, kind of allows you to earn unlimited money regardless of which direction the price moves. Either the stock rises really high and therefore you make more money on the stock than the put option costs you, or the stock goes down a lot and the put option makes you more than you've lost on the stock. Let's show this with an example. You own 100 shares of stock ABC and it's currently trading at $150 a share. To hedge, you buy one put contract with a strike of $150 for Jan 2022, costing you roughly $1,000. Remember, one option contract equals 100 shares. If between now and January the price of your stock rises above $160, you're earning a profit as you've covered the cost of your premium. 10 times 100 shares is 1,000. If between now and January the price of your stock goes down below 140, then you'll earn money off of the falling value. The lower it dips, the more you earn. It's not a perfect hedge, as if the price ends between $140 and $160, you'll be losing money, but the point is that you'll have protected your investment from downturns in price or increases in price from what it's currently at. But what is a divorced put? Firstly, it's a term I coined after arguing with someone over the semantics of a name. I kept saying married puts and then explaining the variance, but I kept getting told that's not a married put. As such, since the variation is that different, I'm calling them divorced puts. In a divorced put, you need two parties. You need your OG shorter, who has sold short shares in a company that they need to cover but don't want to buy legit shares to do so with. Secondly, you need a market maker who is also very likely short on the same stock, who is willing to bend the rules a little and help out the OG shorter. The OG shorter buys either deep in the money or deep out of the money put contracts equal to their short position from the market maker for a date far in the future. Technically, it doesn't need to be deep in the money or out the money puts, but by choosing deep in the money or out the money puts, they can be pretty confident that they're buying and selling to each other due to the relatively low open interest. Likewise, it doesn't need to be dated far in the future, but the further in the future the put contract is, the less open interest it will have, and the longer the OG shorter and market maker have to try and get the price of the stock in question down. The market maker then naked shorts and sells the OG shorter shares equal to their short position. Because market makers have a special exemption where they can create a share that doesn't exist and short it, and then theoretically at some point in the future actually locate that share to deliver. They can do this because obviously they're the market maker and they need to be able to accept trades, whether it's long trades or short trades. If they can't locate a share to either buy or sell, then they can theoretically create it. Again, you can't decide who you buy and sell to on the open market. However, using a combination of naked shorting during low volume times and dark pool abuse, you can be pretty confident of who the shares are going to if you coordinate. The OG shorter now has a short position, the equal amount of shares and put contracts worth the same amount of shares. The OG shorter then uses the shares given to close their short position, just leaving them with the put contracts. I do actually think this research is missing a little bit because I think they also buy in or out of the money call options as well as the put options. Then they then instantly exercise the call options to get the equal amount of shares, but they keep the put contracts, and that's for a little bit later. The market maker also lets these naked shorts become fail to delivers. With this, the short interest has been hidden and transferred into fail to delivers. And effectively that legit short position has been covered and turned into a synthetic share and a synthetic short position, and therefore hidden. As an alternative, instead of exercising deep out of the money puts, the OG shorter could also give the market maker a flat payment for something. Maybe like Melvin Capital paying Citadel $500 million and calling it a redemption, for example. Example of divorced puts. I've always found stuff easier when I can walk through an example. So I'll do that for you now. If you understood the above and aren't interested in an example, just skip to the next bit. So OG Shorter has sold short 100,000 shares of company XYZ when it was valued at $100 a share. The price of XYZ has risen to $250 a share and is at a level where if the OG Shorter was to cover, they would be at a severe financial loss. As such, they call in their market maker friend. The market maker sells the OG Shorter 1,000 put contracts at $5 strike, dated January 2022. The market maker also naked shorts 100,000 shares and sells them to the OG Shorter. Then they let their naked shorts become 100,000 fail to delivers. And that naked shorting of 100,000 shares comes from the OG Shorter exercising those call options that I mentioned earlier. Because I think effectively for the market maker to be able to naked short, there has to be the call options in the first place. The OG Shorter uses the 100,000 shares that they were sold to cover and close their short position. They now only have 1,000 put contracts. From now and until January 2022, the market maker stays in a battle to continually reset the fail to delivers, abusing the T+2 timeline and the T+21 and T+35 timeline to ensure that the true figure of fail to delivers is never revealed. Come January 2022, the puts are about to expire. Either they're exercised or they're not. If they are exercised, then they can become fail to delivers or are re-shorted on the OG Shorter's end. Or if the puts aren't exercised, the market maker keeps them and just tries to deal with the fail to delivers. And here's a breakdown of the number of puts for those date ranges and those price ranges. I've followed the above parameters and done a breakdown. Like I stated earlier, this time I was also interested in the ranges as well. In short, we can see a total of 679,000 put contracts, representing 67.9 million shares being hidden in AMC's option chain. Just under half, 31 million of those, are being hidden in put contracts with a strike of under $8. Like I stated earlier, the OG shorter and market maker are using deep out of the money put options opposed to deep in the money puts. When today's total is added to the 36.5 million shares worth of puts that expired worth on July 16th, we can see at a bare minimum of 116 million shares from the real short interest are being hidden as failed to delivers. When added to today's legit short interest of 85.5 million shares, it gives us a new minimum real short interest of 189.9 million shares, or 39.5% of the flow. Note of caution and hopium. Firstly, my note of caution. Not all of these puts will be hiding short interest. Some may be for people legitimately buying puts for shares they own as a hedge or as a bearish bet. The further out the money they are, or the deeper in the money they are, the less likely this is. Because realistically, probably most people aren't legitly buying an AMC put option expecting AMC to fall back to $8 or $6 or $4 by Friday. That's why I picked the strikes I did. If there is another update on this, you'll see the strikes considered is constantly in flux because I choose a strike that will account for 95% of the puts being bought as part of this tactic rather than just a legit hedge. And as some parting words, this guy's also got a Twitter and a YouTube if you want to view his tweets or his YouTube videos directly. And that's why you shouldn't 100% rely on the short interest data from Ortex, because a lot of those legit shorts have now been hidden in the option chain, and there's synthetic shorts on top of that. Guys, be sure to let me know down in the comments below what you think about the sheer amount of shorts being hidden in the option chain. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!